Hey everyone, thanks for attending our social security webinar. We have a pretty big turnout today, so pretty excited for this. Just wanted to quickly introduce myself for those of you who don't know us. My name is Pat Rufo, one of the partners here at Breakaway Wealth Management. I'm also joined by my partner Dave Kraus as well. A little bit of background about our team. We're a full service firm that focuses on holistic financial planning. We help families get organized across retirement planning, estate planning, and investment strategies. Over the years, we've helped many individuals and families navigate major life transitions by creating customized financial plans and tailored to their unique goals. One area that we often get questions about, especially given recent headlines, is Social Security. Many people that we work with believe that they have a solid understanding of how it works, but the truth is there's a lot of nuance in terms of when to claim benefits, how spousal or survivor benefits work, and how Social Security fits into a larger retirement income strategy. It's a foundational piece of the retirement planning, and making the right decisions around it can impact your long-term financial picture. Whether you're nearing retirement or just starting to plan ahead, understanding the ins and outs of Social Security is pretty crucial for you. That's why we're excited to bring on Brian Doherty, a seasoned expert in the field, here with us today to help walk us through some of the key concepts, strategies, and updates surrounding Social Security. The goal today is just to give you some clear takeaways and practical knowledge that you can apply to your own planning. Take it away, Brian.
Thanks, Pat, and thanks everybody for attending today. I'm pretty confident I'm going to make it worth your while. I've been in financial services for over 35 years now, but the last 15 years have been devoted exclusively to talking about Social Security. I've traveled all over the country. I've been to 49 states. I got to get to New Mexico one day to say I've been to all 50. But so I've done live presentations all over the country, and I've done over 1,000 of them. And sometimes, I do a presentation and I do present a lot to financial advisors like Pat and David. And there'll be 600 in the audience, and a few of them, not many, knew a lot about Social Security. But they always make a point to come up to me afterwards and say, Brian, where'd you get your stuff, this information? Because I've been on, the Social Security website many times. I've read books. I've been to other presentations by Social Security experts, and nobody talks about the stuff you talk about. And some of it is really amazing. One thing in particular is incredibly amazing, and they wonder why everybody doesn't talk about it. I said, I don't know, but now you know. Be sure you go back and tell all your clients and your family and friends, because everybody should know about this stuff before they claim their benefits. So I'm going to, when I get to that part, I'm going to give you a heads up, and you're gonna be happy that you attended. So one of the things I realized about 17 years ago, I used to do retirement income planning training for financial advisors like David and Pat. Back in 2007, 2008, that's when retirement income planning was becoming very popular. Baby boomers were starting to retire and they wanted a retirement income plan. And we had a piece of software that was pretty cool. But one of the things I quickly realized is that people that were having a retirement income plan made or created for when they retired, it was for, when they retired, they hadn't retired yet, but they were getting ready for it. So they hadn't claimed their Social Security. And Social Security income is one of the first pieces of information you would put into a retirement income plan. So I didn't know anything about Social Security, nothing. I decided to educate myself. And from the moment I did, I was blown away. I had no idea Social Security works the way it did, allow people to do the things it allows them to do. It had all these great features and benefits. So I decided to go out and educate people. One of the first things I did was I said, hey, I'm going to write a book. Now, writing a book was not on my bucket list of things to do. I thought it would take me 6 months. It took me 5 years. I didn't know if the book was any good when I, was ready to have it published. I thought it was, but I'm biased because I wrote it. Well, it turns out that my book won the International Book Award as the best business personal finance book that year. It also won the Eric Hoffer Award as one of the best business personal finance books that year. So it's a multiple award-winning book. I'm a multiple award-winning author, and I'm not even trying to sell you the book because all the best ideas from the book are here in this presentation. But one of the things I realize is that your Social Security claiming decision is going to be one of the most important retirement decisions you make in your lifetime. And once you make it, basically you have to live with it for the rest of your life. So you want to make sure you make the right decision, a good decision. You want to make sure you get every dollar of benefit you're entitled to. Because if you don't and you leave money on the table, it really adds up over time. Because if you, for whatever reason, shortchange yourself by, let's say, $500 a month, that's $6,000 a year. 10 years later, that totals 60 grand. 20 years later, it's $120,000. It really adds up over time. So you want to make sure you get every dollar of benefit you're entitled to, and hopefully you'll you have a better understanding of that today. Now, I'm going to share with you some really compelling reasons why you might want to consider delaying. Now, I'm not saying you got to delay till age 70. I'm not even recommending that. Some of you might think when I'm done, hey, all Brian wants us to do is wait to age 70. No, that's not it. Over the last 15 years, I've also done over 2,600 one-on-one meetings with financial advisors and their clients, where I help their clients make the best Social Security claiming decision. And what I realized is that going into those meetings, a lot of people weren't aware of all their claiming options. We're probably going to leave money on the table in terms of lost benefits. I don't want that to happen to you. I'm going to share with you 4 or 5 things I think everybody should know before they claim their Social Security benefits. And if I get done, you still decide to claim at 62 or 63, that's fine. That's your personal decision, but it won't be an uninformed decision. Now, one of the first things, the benefits of delaying, you're probably aware of. And that is the longer you delay, the bigger your benefit will be. But what I found is that most people don't know by exactly how much bigger their benefit is going to be. So you're probably aware you can claim as early as age 62. If you do that, you're going to lock into the smallest monthly benefit every month for the rest of your life. Now, there's some math geniuses out there that crunch the numbers and they put out these white papers, these research papers about what's the best age to claim. The majority of those math geniuses will tell you that claiming at 62 may not be the best decision to make. Or you could claim as late as age 70 and lock into the biggest monthly benefit every month for the rest of your life. And those math geniuses will tell you that might be a better decision to make. Or you can claim at any age in between 62 and 70. But here's the bottom line. For every year that you delay claiming past your full retirement age, your benefit is guaranteed to increase by 6 to 8% per year, all the way up until age 70. Now, I call that a risk-free guaranteed rate of return. In this still relatively low interest rate environment, where are you going to find a risk-free guaranteed rate of return of 6 to 8% per year? Nowhere that I know of. Delaying the claim of your Social Security is really one of the best deals around. And you know what? It gets even better. Because as you're about to find out, or you may already be aware, Social Security has one of the best inflation hedges around. It's called the Cost of Living Adjustment Feature, COLA for short. And whatever the COLA increase is, if you delay past age 62, not only do you get the 6 to 8% minimum guaranteed increase, but you also get any COLA increases on top of that. Let me give you a quick example. Let me take you back to December of 2021. Let's say you're 62 years old and you tell Dave or Pat, hey, you know what? I really like my job. I'm going to work for one more year and delay Social Security for one more year from age 62 to age 63. Well, by delaying that 1 year, you got a minimum guaranteed increase of 7.15%. The COLA increase in 2022 was 5.9%. You kind of basically add those two together. You increase your benefit by a little bit over 13%, and you locked into that increase for the rest of your life. So let's say a year goes by, and now it's December of 2022, and you tell David or Pat that, hey, you know what? I really do like my job. I'm going to work for at least one more year from age 63 to age 64 and delay Social Security for another additional year. Well, by delaying that additional year, you got another 6.67% minimum guaranteed increase. The COLA increase in 2023 was 8.7%. Again, you add those two together, you increase your benefit by over 15% just by delaying that additional year. So, just by delaying 2 years from age 62 to age 64, with a little bit of compounding, you increased your benefit by over 30%, and you locked into that increased benefit for the rest of your life. That's just delaying 2 years. You can delay for 3, 4, 5 years, all the way up to 8 years. And your benefit's going to be bigger because of the 6 to 8% minimum guaranteed increase and any COLA increases on top of it. It's one of the best deals around. After I do client seminars or webinars, some people come up to me and say, Brian, I can't wait till age 70 to claim my benefit. I said, that's fine. You don't have to. But if you just delay for 2, 3, 4, 5 years, your benefit is going to be so much bigger than had you claimed at 62 because of the 6 to 8% minimum guaranteed increase and any COLA increases on top of it. It really is an incredible deal. All right. Now, This is just a bar chart that shows you these are monthly benefit amounts that every year you delay, your benefit goes up. Excuse me. I've been talking all day, but and these haven't been adjusted for inflation. But now let me give you some other really compelling reasons why you might want to consider delaying. One is longevity. I'm just going to take a couple minutes and share with you the complete definition of longevity or life expectancy. I think I'll surprise you with it, and it's good news. Also, talk about how to maximize the dollar benefit of COLA, how you can get the biggest pay raise every year for the rest of your life. Most people lock into the smallest pay raise. I'm going to show you how to get the biggest pay raise. Uh, how to maximize the survivor benefit. Every married couple and some divorced spouses should know how the survivor benefit works, especially if you're a married woman or a divorced woman. And I'll share with you why in a minute. And if we have enough time, I'll take you back to my retirement income planning days and I'll show you how making a better Social Security claiming decision can make your assets and savings last a lot longer in retirement. Now let's talk about life expectancy. Look, this is a term we've heard all our lives. I think most people think they know what it means. But if we put men and women together in this country, they have a life expectancy of age 78. And I think because age 78 is life expectancy, most people think that most people die by age 78. That's not it. Life expectancy is simply a statistical term. And what it means is that, yeah, 50% of people are going to die before age 78, but 50% of people are going to live up to and beyond age 78. And I tell financial advisors and their clients all over the country, if you have a 50% probability of living up to and beyond age 78, you should plan on that happening because that's a fairly high probability. But that's only one aspect of life expectancy. There's a second aspect of life expectancy that hardly anybody knows, and that's this. Here I have a graph. On the horizontal axis, I have ages from age 65 to 105. On the vertical axis, I have the probability of living to those ages. So basically, the longer you live, the farther out you push your life expectancy. All right. So if a man lives to age 65, we'll go up to the 50% probability, which is the definition of life expectancy. If he lives to 65, he pushes his life expectancy out to age 84. If a woman lives to age 65, she pushes her life expectancy out to age 86. And there's a 50% probability that at least one of them, the man or the woman, the husband or the wife, will live to age 90. And but for all the guys on the call, including myself, Dave, and Pat, I got some bad news for the guys on the call. If anybody's going to live to be age 90, it ain't going to be you. It's going to be all the women on the call. Women overwhelmingly outlive men. It isn't even close. In fact, today, currently, if you look at the number of men and women alive at age 85, there are twice as many women alive at age 85 than there are men. There are 3 times as many women alive in their 90s than there are men. And if I take you back to the 2010 census, there were 53,000 people in this country age 100 or older. 44,000 of them were women. Women live longer than the men. Social Security is a bigger issue for them because they receive their benefit payments for a longer period of time than we do because they live longer than us. Now, I'm not trying to convince anybody that they're going to live to be age 90, 95, or 100, but most people underestimate their life expectancy by about 5 years. They only think they're going to live to be like age 80. If I can move that needle out for you into your mid to maybe late 80s, that you have a high probability of living to that age, I think I'd put you in a better position to make a better Social Security claiming decision. And maybe you'll consider delaying your benefits for a few more years because you can receive that bigger benefit for a longer period of time because you're probably going to live longer than you think. All right. And and guys, it isn't all bad news for you. If you live to age 65, you're pushing your life expectancy out and basically into your mid 80s. That's the good news, but chances are, if you're married, you're probably going to predecease your wife and your wife's going to live longer than you. Remember that when I get to the survivor benefit. All right. This cost of living adjustment feature, I spoke about it previously. Look, when I started doing my research on Social Security back in 2007, 2008, and I find out that our government gives this cost of living adjustment feature to everybody for free, I was blown away. I call it one of our government's greatest gifts. It really is. And for most people, it's going to be the only pay raise they get in retirement. If it's going to be your only pay raise, then obviously you want it to be as big as possible. Unfortunately, too many people, well, a lot of people lock into the smallest pay raise. Let me show you how to change that. Now, this is a very simple but powerful concept, okay? So all we're going to do is we're going to look at this top chart, and these are monthly benefit amounts, all right? I'm going to contrast if somebody were to claim Social Security as early as possible at age 62. If they do that, they go to their Social Security benefit statement and says, well, if you claim at 62, we, Social Security, we're going to pay you $1,875 a month. Now, if that same person, instead of claiming at 62, if they were to wait and claim at age 70, they go to the Social Security benefit statement and says, wow, if you wait till 70, we're going to increase your benefit to $3,300 a month. Now, the monthly difference between these two amounts starts off at $1,425 a month. They'd make $1,425 more a month if they claimed at age 70 as opposed to claiming at age 62. Now, with this column here, I'm going to take you 20 years out into the future. I assumed an annual COLA increase of 3%. Why did I choose 3%? Because that's a 75-year average for inflation. All right. So this 1875 a month, 20 years later, with an annual COLA increase of 3%, it grows to 3386 a month. The 3300 a month, 20 years later, with an annual COLA increase of 3%, grows to 5959 a month. And now, check this out, the difference between the two has grown to $2,573 a month. Look at everybody gets the same COLA percentage increase. It doesn't matter when you claim your benefits, but if you apply the same COLA percentage to a bigger benefit, it results in bigger dollar increases every year for the rest of your life. How do you get the biggest pay raise in your Social Security income every year for the rest of your life? Delay claiming your Social Security as long as possible, ideally until age 70, and you'll be applying that COLA percentage to a bigger benefit, and it results in bigger dollar increases or bigger pay raises. You want to get the smallest pay raise every year for the rest of your life? Claim your Social Security as early as possible at age 62, and you'll lock into the smallest pay raise every year for the rest of your life. And once again, people say to me, Brian, I can't wait till age 70 to claim my benefit. I'm like, okay, that's fine. You don't have to. But you know what? Even if you delay for 2, 3, 4, 5 years, your benefit is still going to be substantially bigger than claiming at age 62. And you're going to be applying that COLA percentage to a bigger benefit if you delay for a few years, and you're going to get bigger dollar increases as opposed to claiming at 62. All right. Now, at the beginning of my presentation, I told you I'm going to show you something incredible, amazing, that hardly anybody knows. And for the life of me, I don't know why. I've been talking about this next thing I'm going to show you. This is going to be worth you taking the time to attend this webinar. I've been talking about it for 15 years. I don't know why anybody else doesn't talk about it. I'm the only one that does. But it really is pretty incredible. So to set this up, you know, when I was going to have my book published, I had some really smart math people check the math and make sure it was correct. And a couple of them came back and said, hey, Brian, we understand your concept about applying the same COLA percentage to a bigger benefit, get bigger dollar increases or pay raises every year for the rest of your life. But you have a major, major flaw in that analysis. I said, I do. What is it? Well, they took me back to this chart here, this monthly benefit chart. They said, look, you have this person claim at age 62. Now you take them out 20 years in the future. You had 20 years to age 62. Brian, that brings you to age 82. Now, instead of them claiming at 62, you have them claim at age 70. You also take them out 20 years into the future. If you had 20 years to age 70, that brings you to age 90. Brian, you are not comparing apples to apples. And if you did, you'd have to look at what this amount, 59.59 a month, would be at age 82, not age 90. It's going to be a lot smaller than 59.59. That means the difference is going to be a lot smaller, and you're actually going to make the case stronger for claiming early. Now, on the face of it, it seems like a really valid point, but it's not a valid point because of the incredible way that Social Security credits COLA if you delay. In fact, when I first read about this on the Social Security website about 17, 18 years ago, it is on the website. You got to look real hard because the website has over 50,000 pages, and this is only about 2 paragraphs, but it's there. When I first read about it, I was like, wait a minute, I can't be reading this right. Nobody can do this. So I reread that part 5, 6, 7 times. I finally realized I am reading it right, and I also realized that only the federal government can do what I'm about to show you. I don't think any other private company could do this and stay in business that long. All right. So, you know, over the years, I've done a bunch of short videos on Social Security topics, 3 to 5 minutes, put them up on, you know, YouTube, get, I don't know, 20,000 views or whatever, no big deal. But I did one 5 or 6 years ago. It's my most popular video by a factor of 30. 30 times more people watch it than any other video I did. And the title of the video was, or actually is, it's still up on YouTube, your Social Security benefit statements are wrong. They are absolutely wrong, but they're wrong in a good way because your actual benefit amounts are going to be substantially bigger than the benefit amounts that appear on your Social Security benefit statement. So here's how it works. All right, I'm going to take you up here to this small chart. And I'm going to say this is representative of your Social Security benefit statement, but we're only going to look at three benefit amounts. And everything plays off of the full retirement age. We assume this person had a full retirement age of 66. They go to the Social Security benefit statement and says, well, if you claim at 66, we Social Security will pay you $2,500 a month. Now, the other benefit we're going to look at is if they claim as early as possible at age 62. Again, they go to their Social Security benefit statement and says, if you claim at 62, we're going to decrease your benefit to $1,875 a month. The third benefit amount that we'll show you, or well, that we're going to look at is if you claim at age 70, you get the biggest Social Security benefit. Go to the Social Security benefit statements. If you do that, we'll pay you $3,300 a month. All right. Now we're going to go down here to this column. We have column A, we have the claiming ages between 62 and 70. Column B, I show you what happens if they do claim at 62. They start off at $1,875 a month, and it goes up a little bit every year because of the annual COLA increase. All right. Now, check this out. If they actually wait and claim at age 66, they're not going to get $2,500 a month. They're going to get $2,813 a month. Why? Because if they wait till age 66, remember they're 66, Social Security is going to take this $2,500. They're going to go back in time to when they were age 62. They're going to see what the COLA increase, that percentage increase was for that year when they were 62. They're going to take that percentage and they're going to apply it to the $2,500. Now that's going to increase the benefit. Now they're going to take that new bigger benefit. They're going to go back in time to when they were 63. They're going to see what the COLA percentage increase was for that year when they were 63. They're going to take that percentage. They're going to apply that to that new bigger benefit, which is going to make it even bigger. They're going to do that for 4 years in a row. So if they claim at 66, they don't get $2,500 a month. They get $2,813 a month. Why? Because they end up getting 4 years of what I call retroactive COLA credits. Now, ladies and gentlemen, the story gets even better. It gets a lot better if they wait until age 70. They're not going to get $3,300 a month. They're going to get $4,180 a month. Why? Because they get 8 years of retroactive COLA credits. That's incredible. This is absolutely the way it works, right off of the Social Security website, and nobody knows it works like this. Well, I can't say nobody because I've showed it to well over 100,000 people and now I've showed it to you. You should go out and tell everybody that your actual Social Security benefit amounts, when you go to claim them, are going to be bigger than the benefit amounts that appear in your Social Security benefit statement. That's really, really good news. Now, I'm going to go back real quick. Remember those smart people I had, that checked the math in my book? And they said that I wasn't comparing apples to apples because this is their age 90 benefit amount. No, it isn't. This is actually their age 82 benefit amount. You know why? Because if they wait till age 70, they get retroactive COLA credits going all the way back to age 62. So they get 8 years of retroactive COLA credits, and then 12 years later, their benefit at age 82 is now 59.59. It does include 20 years of COLA increases. So this is their age 82 benefit. I am comparing apples to apples, and this is the difference between those two benefit amounts, claiming at 62 or claiming at 70. Now, I also want to show you one more thing. One of the second most frequently asked question I get is, hey, Brian, what's the break-even age? Somebody will ask me, I've gotten this question hundreds of times, because usually, and we're going to give you the opportunity to ask questions at the end of this presentation, but somebody will say, hey, Brian, what's the break-even age? Yeah, sure, I can claim it at 66 and get 2,500, but I could have claimed 4 years earlier. Yeah, the benefit is smaller, 1875, but I would have got 4 years of Social Security income before I even claimed at 66 if I waited till 66. So how this benefit at 66 is bigger, but how long would it take to make up for the 4 years of income I didn't receive? So now, just based on my experience, the majority of people that ask me this question are usually guys, because guys think they're really good in math, right? And I also realize after answering it a few times that they've already done the calculation. They've already figured out what the break-even age is between 66 and 62. So I ask them, have you already done the calculation? Yes. And what is it? It's the same for everybody. It takes 12 years till age 78. And some of them say, I don't think I'm going to live that long, so I claimed at 62. First of all, they don't understand life expectancy. But the next question I asked them, I said, hey, let me ask you a question. When you did the break-even age calculation, did you use the benefit amounts on your Social Security benefit statement? All of them say, yeah, of course we did, Brian. I said, well, now you know those benefits are too low. You calculated a break-even age that was too high. And, if you're going to make a decision when to claim Social Security based on some, metric, at least you should calculate it correctly because everybody, the hundreds and hundreds of people that asked me that question, calculated the break-even age incorrectly. They calculated a break-even age that was too high because they used the benefit amounts on their Social Security benefit statement, which are too low. And what you have to do is you have to assume some rate of inflation, either 1.5 or 2%. And if you do that, you're probably going to bring that break-even age down because of retroactive COLA credits by anywhere from 2 to 3 years. And if you assume a higher rate of inflation, maybe 3, 4, even 5%, you're going to bring it down even further. So, if you're going to make a decision based on the break-even age, you should calculate it correctly. And nobody does. All right. So let's talk quickly about the survivor benefit. I've done 2,700 meetings with advisors and their clients. Probably 75 to 80% of them are married couples. Here's what I tell every married couple at the beginning of the meeting. I say, look at whoever has the bigger benefit. That's the more important benefit of the two. And if you're going to delay claiming one benefit, it should be the bigger benefit. You should do it for two reasons. One, if you delay the bigger benefit, you're going to make it even bigger. You can both enjoy that bigger benefit while you're both alive. And two, that benefit is eventually going to become the survivor benefit or the only benefit the surviving spouse will receive after the first spouse dies. Once the first spouse dies, that smaller benefit stops. You're never going to get it again. The surviving spouse is only going to get the bigger benefit every month for the rest of their life. All right. So here I have an example where the wife's full retirement age benefit is $1,900. The husband's full retirement age benefit is $2,500. Now, the only reason I made the husband's benefit bigger is because 75% of the time today, the husband has the bigger benefit. Statistically, that's just the way it is. But if the wife had the bigger benefit, I'd recommend that she delay claiming it as long as possible. All right. So I'm going to give you a quick example here, and I'm going to surprise you with something with this example. So again, same benefit amounts for the wife and the husband. Here on the far left, we only have the husband's claiming ages. We're going to look at him claiming at 62, 66, or 70. Check this out. Here, the wife's monthly check at age 82. Look at age 82, the check's the same, 2573, regardless of when the husband claimed his benefit. Why is that? Well, believe it or not, I had in every instance, in this case, I had the wife claim her benefit at age 62. Why would I do that? I just gave you all these great reasons why, the benefits of delaying. Well, those math geniuses that crunch the numbers and put out those white papers, they'll tell you, and it makes sense to me, that whoever has the smaller benefit should probably claim it early, even as early as age 62. Why? Because that's the benefit you're going to receive for the shortest period of time. Because once the first spouse dies, that benefit's going to stop. You're never going to get it again. And if you delay claiming it, you're going to shorten the period of time you receive it even further. So claim it early, even as early as age 62. So that's what I did. And 20 years later, because of those annual COLA increases, the wife's check has grown to $25.73 a month. Now, if the husband also claimed at 62, 20 years later at age 82, his check is paying him $33.86 a month. We add these two checks together, their combined Social Security monthly income is $5,959 a month. That's pretty good. If you annualize that, you multiply it by 12 because that's only a monthly benefit, that's almost $72,000 a year. That's pretty good. But check this out. Here, we assume the husband dies at age 82. This check goes away. Now the wife is only getting $37.25 a month in the form of a survivor benefit, which is paying her $44,700 for the year. Remember, when the husband was alive, they were making almost $72,000 a year. He dies and her income drops to $44,700. That's a drop of almost $30,000 a year. That is significant. Now, if the husband had waited till age 66, the one survivor benefit check, 4515, would have paid her 54,180. That's better. But better yet, best yet, if he had waited till age 70, the one survivor benefit check would have paid her $71,508. It's much easier to live on the 71,000 as opposed to the 44,000 or even the 54,000. All right. That's how the survivor benefit works. Let me show you one more thing that you'll never see anywhere else because I stumbled upon this one day about, I don't know, 15 years ago, just crunching some numbers myself. It's in my book, but I don't think you'll ever see it in any other book. So all we did was this is the same chart as the previous slide. We just took out the age 66 line where the husband claims at age 66. So all we're going to do is we're going to compare if both the husband and wife claim at age 62 to if only the husband who has the bigger check if he waits until age 70. So if they both claim at 62, 20 years later, the husband's getting 33.86, the wife's getting 25.73. You add those two together and they total 59.59 a month. Those are those two checks combined, right? So if only the husband who had the bigger benefit, if he had waited till age 70, the one survivor benefit check is as big as these two checks combined, had they both claimed at age 62. That's how you leave a survivor benefit that is as big as two checks in one, greatly reducing the probability that their surviving spouse, which is overwhelmingly the wife, is going to struggle financially after the first spouse dies. All right, before we go on, let me leave you with one incredible, almost unbelievable statistic right from the Social Security website. When I first read about this or saw it, I was like, oh man, that can't be true. But it is. So Social Security sends out 70 million benefit checks every month. Of those 70 million benefit checks, 4 to 5 million of them are survivor benefit checks. And they'll tell you right on their website of the 4 to 5 million survivor benefit checks they send out every month, 95% of them are sent to women. 95%. That's incredible. So I tell every married woman and a divorced woman that's qualified to get a survivor benefit at some point in your life, that survivor benefit is probably going to play a very important role, maybe even critically important role in you maintaining your quality of life and standard of living after your husband dies or your ex-husband dies, because the probability that he will predecease you is very high. And then all you're going to get is a survivor benefit from Social Security. It's very important. You know what? All right. Let me do this real quick, and then I'm just going to talk about the spousal benefit. Then I'm done, and we'll open it up for questions. So I'm going to take you back real quickly to my retirement income planning days, and how making a better Social Security claiming decision can make your assets and savings last a lot longer in retirement. So what we're going to do is we're going to compare this claim as early as possible strategy, where I would assume this is a married couple. It doesn't have to be a married couple, though. It works if you're single or divorced or widowed or widower. But let's say they both claim as early as possible at age 62. I'm going to compare that to a strategy I like. I call the claim early, claim late. Whoever has the smaller benefit claims it early at 62. Whoever has the bigger one waits till 70. Okay. They have an annual income need at age 70 of $100,000 a year. Pay all their bills and enjoy their life, right? Now, don't get caught up in that 100,000. If your annual income need is 50, 60, 70, 80, or maybe it's 125 or 150, it still works. So if they both claimed at 62, at 8 years later at age 70, because of the COLA increases, Social Security is going to pay them $50,160 for the year. Now, if they use the claim early, claim late strategy, I recommend we're going to increase their Social Security income to $71,820 for the year. So we've increased their Social Security income by almost 50%. Now, David and Pat know that the biggest challenge in retirement is longevity risk, the risk of living too long. Look, all these meetings, one thing I've learned is that people mistakenly think that the biggest risk is dying young. And purely from an economic and financial standpoint, dying young is not the problem. Dying young solves all the problems, because when you're dead, you stop spending money. Living long, the longer you live, it becomes harder to maintain your quality of life and standard of living for a number of reasons. Longevity risk is the biggest risk in retirement. So can you get longevity insurance? Yeah, you can. You know what the best kind is? Guaranteed lifetime income you can't outlive. That's exactly what your Social Security income is. Look, I tell financial advisors and their clients all over the country, you can outlive your assets and savings, but you cannot outlive your Social Security income. You're going to get it to the day you die. And you should take a lot of comfort in that. So just by helping them make a better Social Security claiming decision, we got them 50% more longevity insurance, which decreases the biggest risk in retirement, longevity risk. That's a good thing. One of the other biggest risks is withdrawal rate risk. I've talked to thousands of financial advisors around the country, and sometimes they'll come up to me and say, "Hey, Brian, I got a client, retires with $2 million. They think they're a millionaire. Well, technically they are a millionaire. They got $2 million, but they think it's going to last forever. And what do? They go out, they buy great vacation homes in Florida or Arizona. They buy homes for their kids. They take these incredible vacations. They buy these incredible cars. And, 6 or 7 years later, they're down to, $600,000. Their 2 million is going from 2 million to 600,000. They're like, what did you do to me? The financial advisor says, I didn't do anything to you. The market's been incredible for the last 10 years. You've just been taking out too much money, withdrawing too much money. So here they need 100,000 with the claim as early as possible strategy. At age 70, Social Security provides 50,160. That means they have to withdraw $49,840 from their accumulated assets and savings to meet their income need of 100,000. Over here, we increase their Social Security income to almost 72,000. Now they only have to withdraw $28,000 a year to meet their income need. Look, and I'm not a math major. You don't have to be to realize that if you're only withdrawing $28,000 a year as opposed to $50,000 a year, your assets and savings over here with the claim early, claim late strategy are going to last a lot longer, probably as long as you live. All right. One of the third biggest risks is inflation, keeping up with the rising costs of goods and services. Remember, I told you Social Security has the best inflation hedge around this COLA, the cost of living adjustment feature. They need 100,000. Social Security provides 50. So that means 50% of their income need is automatically going to adjust to inflation. But over here, we increase their Social Security income to almost $72,000. That means 72% of their income need is automatically going to adjust to inflation. So by making a better Social Security claiming decision, we put them in a much better position to keep up with inflation in retirement. So recapping real quick, and then we're going to move on. Making a better Social Security claiming decision, we greatly reduce longevity risk, biggest risk in retirement, withdrawal rate risk, and inflation risk. It's all good. And we put this person or this married couple in a much better position to be more financially comfortable and less stressed out about money in retirement. I think that's what we all want. All right. I'm almost done. Thanks for listening. But I got to tell you about this spousal benefit. When I'm doing my research, people are a little cynical or skeptical about government programs. They don't do the right thing. I got to admit, I was that way myself. But when I did my own research about Social Security, I uncovered so many surprises. And you know what? They were all good ones. I was like, wow, this is an incredible program. And that's why I felt I got to write it. I got to write a book about this to tell everybody what an incredible program it is. And this is one of the most incredible features about Social Security, the spousal benefit. One spouse is entitled to 50% of the other spouse's work history benefit at full retirement age. Let me give you a quick example to illustrate how this works. So we have a husband and wife. Chris, the husband, leaves the wife. Chris's full retirement age benefit is $2,000. Lee's is only $500. They're the same age. They have a full retirement age of 66, and they both plan on working until 66, retiring and claiming Social Security, which they do. Chris retires, claims Social Security, gets his $2,000. We didn't adjust this for retroactive COLA credits or anything. Lee, she also retires at 66. She claims her Social Security. She gets $1,000 a month. Why? Because she's entitled to a spousal benefit, which is going to pay her 50% of Chris's $2,000 or $1,000 a month. If she wasn't qualified for a spousal benefit, she only get $500. But because she is, she doubled her income and gets $1,000 a month for the rest of her life. Or unless Chris predeceases her, then she can switch to his bigger benefit. All right, that's pretty cool. But check this out. Here's something that hardly anybody knows. So let's say I'm talking to Chris and Lee, and I say, hey, Chris, you got the bigger benefit. Try to delay it, man, at least to your full retirement age, 66. And Chris says to me, Brian, look at, I've worked for 40, 45 years. I've paid all those FICA taxes. Those are the Social Security taxes that come out of your paycheck every pay period. I've paid hundreds of thousands of dollars into Social Security. I'm not taking the chance of waiting till age 66. What if I die at age 64 before I claim it? I end up getting nothing. I'm not taking that chance, Brian. I'm claiming as early as possible at age 62. I don't care if they decrease my benefit, which they do. Instead of Chris getting $2,000, his benefits reduced to $1,500. Now, Lee says to Chris, hey, you know what, Lee, I like my job. I'm still going to work to age 66, retire and claim Social Security, which she does. Check this out. She still gets $1,000 a month. You would think that because Chris claimed his benefit early and it's reduced to $1,500, 50% of that is $750, and that would be the size of the spousal benefit we would get, $750. But it doesn't matter when Chris claims his benefit. If Chris claims it early or Chris claims it late, Lee's still entitled to 50% of his full retirement age benefit, or $2,000 or $1,000 a month. She still doubles her income. Spousal benefit is really a cool thing. And I got to tell you, from advising a lot of married couples, Way if they're gonna screw up, is probably gonna be around claiming the spousal benefit. All right. So one more thing I want to offer to you for free service through Dave and Pat and my sponsor, who is Rich Burt from Touchstone Mutual Funds. I created a Social Security calculator. I've been revising it for the last 14, 15 years, making it better and better. I think it's the best one around. And we'll offer you a free analysis of your personal Social Security situation. And all we need is a few basic pieces of information, your marital status, or you're married, single, widowed, divorced, your dates of birth, married couple for both spouses, and your Social Security full retirement age benefit amounts, which you can get right from your Social Security benefit statement. That's all we need. Plug it into my calculator. I call it the Claim with Confidence Social Security calculator. It'll show you up to a maximum of 3 potential claiming strategies for your personal, unique Social Security situation. And then if you want, we'll even get on the phone with you and if David's your advisor or Pat, and I'll help you, ask you a few questions and help you pick the best claiming strategy for your personal, unique situation. I highly recommend you take advantage of this. And one of the last things you should do is thinking, maybe your safety net or for you would be to go to Social Security itself and they'll tell you what you should do. That is a very, very bad plan. Unfortunately, Social Security customer service employees give out incomplete and wrong information all the time. It's a huge, huge problem. And I got some concrete proof to back this up. 4 or 5 years ago, Social Security published the results of an internal audit they did on their own customer service employees. I don't think they wanted to publish these results, but I think they had to. And what they did, well, keep in mind, 70 million people get a Social Security benefit check every month. Now, they looked at a sample size of 13,000 cases out of 70 million. And what they concluded was in over 11,000 of those cases, their customer service employees gave out incorrect or wrong information, and it cost those 11,000 out of 13,000, it cost them a cumulative total of $142 million in lost benefits. $142 million. That's bad enough. Even worse, they reported these results 4 or 5 years ago. They haven't done anything to correct their mistake. They haven't done anything to make these people whole. I think they just say, yeah, our customer service employees give out incorrect information, all the time. It costs them, $142 million, but they're just going to have to live with it. And you know what? Those 11,000 people that were shortchanged, they don't even know they've been shortchanged. So even if you think your case is pretty straightforward, have an analysis done. If we run it through my calculator, we'll make sure you're aware of all your claiming options and get every dime of benefit you're entitled to, and don't leave any money on the table in terms of lost benefits. So with that, Pat or David, I'll turn it over. If you want to, answer some questions, I'll be happy to do that.
Yeah, thank you so much, Brian. This was super informative. I don't know if we can open up the webinar to questions. If we could have if anyone has a question, we can open it up to questions.
Is there a way to raise their hand or unmute anybody with a question?
Yeah, Brian, are you able to do that behind the scenes
Yep,
for us?
anybody who has a question can raise their hand. They can just navigate to the React button. If you click on the React button, there's an option to raise your hand. I can select you, and then we can unmute you.
Great. All right. If we don't have any questions, well, you go, Dave.
Well, I was just going to say, Brian, the one question that we do get a lot, Pat and I hear all the time, and I'm curious your input, is the idea that Social Security is running out of money. So many clients say to us, well, what if this benefit doesn't even exist for us in 10, 15 years? What's your, I guess, opinion on that, and kind of where do you stand with that?
Yeah, David, that's a great question. That's probably the most frequently asked question I get. And I think it's almost universal that people think Social Security is in a lot of financial trouble and eventually could run completely out of money and stop making benefit payments. So people use that as a reason to claim early, get as much money out before Social Security goes totally broke. Well, Social Security will never, go totally broke, and I'll tell you why in just a minute. But let me tell you why people have this misperception. Um, well, back in 1983, the last time they addressed this long-term funding issue, and by the way, Alan Greenspan was chairman of that committee. He went on to become chairman of the Federal Reserve Board. What they did was they increased the FICA taxes, those taxes that come out of your paycheck. They increased them to 6.2%. And they knew for about 30 years they were going to take in more money from those FICA taxes than they had to pay out in benefits. So every year there'd be a surplus, there'd be money left over. They put that into a surplus account. At one point, there was $2.7 trillion in that surplus account. But they also knew that 30 years down the road, when the baby boomers really started to retire, they'd start to take in less money from those FICA taxes than they had to pay out in benefits. So in order to pay full benefits, they'd have to dip into that surplus account, which they've been doing for a number of years. There's about $2.5 trillion left. Okay. So Social Security trustees put out a report every year. And one of the first things they do is they update you on the financial condition of Social Security. And they'll tell you that if the politicians don't do anything to address the long-term funding issue, because there is a long-term funding issue, then in the year 2033, 2034, that surplus account that used to have 2.7 trillion in will be totally exhausted. They will have used all that money to pay everybody their full benefit payments. All right. And if they don't address the issue by 2034, then they'll have to reduce everybody's benefits by about 20 to 22%. Okay. But once they do that, Social Security, if they have to, and I don't think they will, Social Security is on sound financial footing if they have to reduce everybody's benefits by, let's say, 20% year 2034. They can make all their benefit obligations through the year 2099, almost into the next century. That is the worst thing that can happen. What people misinterpret is that when that surplus account that now has 2.5 trillion in it, when that's gone, Social Security is totally broke, has no more money. No, that'll never happen. Those FICA taxes that we pay come out of our paycheck every pay period. Social Security brings in about $100 billion a month, over $1 trillion a year. They'll never go broke and completely stop making benefit payments. But if the politicians don't address the issue by 2034, technically they'd have to reduce everybody's benefits by about 20%. I don't think that'll happen. I think when push comes to shove, they'll get around to fixing the system. And I also think that if there are some benefit cuts, people like myself, I'm over the age of 60, you have clients over the age of 60, will be grandfathered. Because the last time they fixed the system in 1983, they did institute some benefit cuts, but they implemented them over 20 or 30 years, and people that were 55 or 60 and older were grandfathered. They weren't affected by it. Now, David, Pat, you look like young guys. If they do make some benefit cuts, and they probably will, you might be affected by it, but you may have a longer period of time to make up for it. I fully expect if when they get around to fixing the system, if there are benefit cuts, guys like myself over the age of 60 will be grandfathered. I can't say with 100% certainty that'll happen, but that's what they did the last time. And let me just make a couple quick points about how important Social Security is, because as I said, 70 million people get a benefit check every month. Of those 70 million, 20 to 25 million of them, that's all they got. They'd have no other source of income in retirement. So if Social Security were to stop making benefit payments, you're talking about pushing 20 to 25 million people not only into the ranks of poverty, but they'd be homeless and destitute. That isn't going to happen. Look, the politicians know how important Social Security is, and when push comes to shove, I think they're going to get around to fixing the system. There might be some benefit cuts, but we'll be grandfathered, and it's not a good reason to claim your benefits early because you think Social Security is going to go totally broke and stop making benefit payments altogether. I say with 99.9% certainty that'll never happen.
Awesome. No, I appreciate the color. I see Vincent Kellett has a question. Are we able to open that up to him, Brian?
How do you go? What do you need to do to get your Social Security analysis?
You can go through David or Pat. I'll have a form that we can send it to David and Pat that they can send to you, and you fill out just the few basic pieces of information we need. They'll get it to me. I'll run the analysis. We'll send it back to David and Pat and send it to you. And if you want, after receiving that, we can set up a Zoom call. I live up in Saratoga Springs, New York, not far from, I think, where you guys are located.
Mhm.
and we can do a Zoom call and we could go through the report. It only takes like 15 minutes and ask you a few questions and help you pick the best claiming strategy for your situation.
Yeah,
Okay.
so we'll yep. So we'll work on all the details of that for you, Vincent. Any other questions? Yep. Gary,
Can
I
you hear
think
me?
you're on. Yep.
Cool. Listen, I just wanted to say thanks. I think this was a great webinar. I really appreciate you guys setting this up.
No problem. Anytime. We're gonna try and do more of these in 2026. So keep an eye out for more of these emails to come over the next 12 months.
All right, I think that's pretty much wraps it up with all the questions. So again, Brian, we really appreciate it. This was super informative. And look forward to speaking to you again. Any questions that anyone has post call, please feel free to reach out. We'll reach out proactively as well, and look forward to speaking with some of you guys in the future.